Good morning. In this video, I will try to show you how the money moves between bonds and stocks. Maybe you have heard about stock market and maybe you have heard about bonds. Now, what are bonds? Bonds is just you give a loan to the government. It means you give them money and they give you interest rate. Okay, let's say the bond, we say, for example, you buy $1,000 of bonds, wherever it is, $1,000, and they give you, for example, let's say 7% each year profit for, let's say, 5 years. Okay, so most of the time it goes to the government. It means government. How does it work? It means you lend the government money. You lend them money, and in return they give you interest rate. In return, okay, they give you interest rate. Okay, now this is the bonds. Now in the stock market, you buy stocks for two reasons. In the stock market, when you buy stocks, you buy them for two reasons. For the money, yes. For what you call the capital gain. Capital gain, sorry for the spelling. Capital gain, it means the price appreciate. It means price goes up, so you make more money. Plus, some stocks give dividends. Okay, they give some profit from the company to you. So there are two things: dividend and price appreciation. This is for the stock market. Now for the bonds, you lend the government money or the state, or it depends on the or corporation. It could be state, it could be the municipal, or it could be a corporation that needs money. Okay, and they give you percentage interest rate for each year, and there is a contract like for 5 years, 6 years, 10 years, and then they give you your money back. Now what did happen in 2008? We have what we call the housing crisis. Now the housing crisis, and there is a general crisis in the stock market. All the stock market, most of it has a problem and the prices go down. So 2008 was a crisis, was a small catastrophe for all the economy. So there is a drop in the stock market in almost all the stocks, and the stock markets go down. You can see here. This is the Dow Jones Industrial 30 stocks. Now see all these years. This is 2008, 2007. This is 2008. Now 2008, there is a big drop of the price in almost all the stocks. Now you ask yourself why? Because there is a crisis. A lot of companies, especially banks, related to what we call the housing problem. Since they have problem, and people cannot pay their mortgages, so we have millions of foreclosures. It means people they cannot pay anymore, and the consequence, they lose their houses. Now when they lose their houses, the banks lose money because they have no income. They have no interest from the mortgages. So a lot of banks go uh, bankrupt. It means they lose the business. Some other banks, they get help from the government. Some, they just go bankrupt. Okay, because the people, they can't pay. You cannot put all the people in prison because they can't pay. They have no money. So that's why we have what we call housing crisis. Now, what happened after 2008? Okay, people who are lending the government money for 7%. Now, what did happen in after 2008 for bonds? Now, since bonds is just you get paid from interest rate. Now, since the housing problem, people, they cannot pay, so interest rate went down. Okay, after it was like 7% in 2007. For example, 2007, if you want to buy a house, they will ask you, for example, 7% or 8 or 6, depending on your credit score. Now, in 2007 was so high, so people are buying bonds. But in 2008, what happened in 2008? So the bonds goes to 5, then to 4, and then now is 3. I think it's 350. Okay. Now, people who are having bonds, they don't like this 3.50. So what they do, they sell their bonds, and so are the investors. They sell bonds, so the bonds, because they have no money at all, 3.50% each year is not good for them. So they take their money from bond, they sell all their bond, and they go where? They go to the stock market. So all the money goes from the bonds to the stock market. See what will happen? Now, all this here, all the collapse of bonds and the stock market in 2008. But later, those people who sell the bonds, they go to the stock market. That's why in 2009 until 2013, we have 5 excellent years of very good income. Okay, and all the people who buy in 2009 buy stocks, and now they get a very large profit. Okay, so this is the way money moves. Okay, this is the way investors switch their money from bonds with lower interest rate to the buying stocks in 2009 to the present day. So big investors, they are looking for money. They don't care which vehicle they can get money. Wherever they find money, they go there. Now, these investors are professional with billions of dollars. Most of them are millions of dollars, but most of them, they have billions of dollars, and they take the decision. That's why in the market, you say why there is a big candlestick, red big candlestick, and all the people are selling in one year. Why they don't sell in the other years? They sell in these years, precisely 2008. It's because of the housing problem, and all the market goes down. There is a lot of unemployment, and thousands of people lose their jobs. They lose their houses, and they lose their wives, because wife, okay, no house, no man, and some people are homeless because of that. And you see this trend. Now, thank you very much for watching this video. If you have any question or any opinion or comment, please comment below. Thank you very much for watching this video.